ladies and gentlemen, it has come that time in which we will have our strategy meeting. And we do this about every 4 or 6 weeks or so. And this is going to be a really important one because of all the things we have going on in the coming weeks. It's the last earnings season before the holidays. It'll be the last one that we have before the end of the year and all that good stuff. We have all these trade talks and headlines, and for this conversation, we are going to bring in event trader, chart trader, blue chip trader, and scalp trader. I'm going to welcome all you gentlemen in with a hello, and I'm going to start the conversation off with Brett and Gavin. And the reason why is because we have a lot of talking points as far as the overall economy, but first and foremost, when dealing with a top-down approach, which you guys tend to do pretty frequently, dealing with these headlines and all the bobbing and weaving that you have to do, it's been a very frustrating time to say the least. And Brett, I've noticed that your overall activity level has been somewhat limited relative to where the VIX is and how active you usually are when we're around this 20 level. What is your overall advice that you would give to people when dealing with this? Because you stated earlier that you don't remember a time, and neither do I, that the president or Washington has had such an impact on the day-to-day and almost minute-by-minute trading opportunities out there. What's your advice for people?
Okay, well, there's a couple of different points. So first off, this is an extremely unusual environment, and I suspect that we have a lot of people who are trading with us who have gotten started in their trading careers just over the last 3 years. So this is effectively normal to them, and it's just not normal to anybody who's been trading longer than that. It's a very strange moment in history for markets to have so much to be controlled so heavily by moment-to-moment headlines, particularly headlines that have such political consequences and such political motivations and are so clearly about gaming the public perception. That's not typical. In the past, political headlines have been, about when something passes or doesn't pass, votes going on, and not strategic language meant to attempt to manipulate perception one way or the other. So it's not just the rate and the control, it's the intent. And all of these things are really unusual. But as far as frequency of trading relative to volatility, typically when the VIX is above 17.5 or 18.5, I tend to trade more. But as I said Tuesday and last week, when that volatility is driven by headlines and almost all the movement is in immediate reaction to headlines, that kind of goes out the window, and I try to lessen my behavior. And the main reason is, there's something I posted yesterday, actually morning in my notes, which was the reason why trading, and particularly top-down trading, is possible is because crowds of people are possible to predict. There are predictive patterns, there are recurring patterns, human nature is a constant, and when people gather together into groups, there's a game theoretic landscape that starts to play out, and people are put into certain positions, and en masse, you get a kind of average response. You don't need to predict what any given individual is going to do. You're predicting an average response of a crowd of people interacting in a complex system, and those yield predictable and recurring patterns of behavior, but you can't predict an individual. No economist is going to, for instance, try to make a projection on whether Bob Johnson, who lives at 248 Maple Drive, is going to purchase something tomorrow at a store, right? But they can come up with a prediction about how all Americans may behave in terms of their spending on that same day. And they have a chance of getting that, roughly correct, but they don't have any chance of getting correct whether Bob Johnson's going to go to Best Buy and buy a TV. There's no chance of that. There's no chance in predicting what an individual will do. And a lot of these headline-based moves are about really predicting what some one person is going to decide to do. But inside of that, I want to spend a moment just quickly deconstructing this morning's headline and the one that caught me off guard, to get a sense of the complexity of trying to understand the impact of the headlines, because that's also important. So you have a situation coming in today We've got the 10-day put call average, which is still really elevated. In other words, people are buying lots of puts relative to calls over the course of a prolonged period of time. So there's a pessimism in there, and there's a malpositioning to the long side. You have AAII bulls, which are at 21. In other words, 21% of active market participants who were surveyed think the market will be higher 6 months from now. So 79% don't. That's a very anomalously low number. So people are skeptical, they're pessimistic in the midst of this whole situation. And the tweet this morning from Trump is actually maybe more important than it looks. On the one hand, he completely managed to dissuade the notion that that SCMP article last night was suggesting Chinese delegates would be heading home tonight, which would be Friday in China. It said Friday, and that could mean that they're going tonight. Some people picked it up and said that's just after one day of negotiations, they're going home earlier. So by saying he's got a meeting with Liu He tomorrow, he's dispelling that notion. But there's a more important dynamic. The more important dynamic of this headline is that China came out flat out earlier in the week and said they aren't even considering addressing IP laws, China industrial subsidies, the Made in China 2025, or any of the structural issues that are part of this negotiation. They're not even considering it. They won't even let it on the table. They're offering increasing ag purchases and a currency deal in exchange for pausing the addition of new tariffs. That's a deal inside of a deal. It's not even a temporary deal. It's not an interim deal. It's not a deal in any way. It's a deal about how this is going to go until there's a deal. And that means they're offering very little, and what they want is for there to be a pause in any new tariffs. And here's the big point. Trump's tweet today says he's fully aware of that, and he's still willing to go on with the negotiation, which means he's still at the table even after knowing what they're definitely not going to do, which means almost certainly now we know there's probably going to be some kind of temporary deal. And all of those levels have to occur to you instantaneously. The market can figure it out. But when you've got people pessimistically positioned, you have to take into account where people are positioned, what the larger context of that is, and not get sucked into the idea that you can predict what next headline is going to be there. So you have to quickly analyze it. You have to get very involved in these narratives. It's worthwhile to get very involved in them so you understand this reasoning process and the implications of the headline. But yeah. Inside of this situation, there's going to be lots of moments where you get caught off guard, and that's why we call it a headline minefield, because you walk across it as a trader, and you can step in the wrong spot and blow yourself up instantly. So either way, leverage is lower, frequency of trading is lower, get involved in these narratives, understand the implications of these headlines, and understand whether or not you should fade after the fact once you know the headline is out. In this case, I chose not to once I realized that the headline was there. I got caught on the first one because I put out a fade almost at the same time the tweet went out, and that'll happen. But in the aftermath, whether or not I went back after it, once I examined the situation, I saw that that was probably unwise.
So it sounds like to me, if I can use an analogy, if you were a boxer, you would take somewhat of the Floyd Mayweather approach, where you're
Yes.
going to wait for your opponent to take a swing, take a jab, whatever, and counter move. And so wait for the headline.
Interject one thing. Let me just interject one thing. I once wrote an entire essay on the fact that every trader should be Floyd Mayweather. Just in general. His boxing style should be your trading style, period. But
all right, well,
if you're a Floyd Mayweather fan, you understand what that means. That means you're very strategic in your use of risk, and risk is an asset.
All right, so I didn't even know that. So the force is with me there, Brett. How do you like that?
Yes, I like it.
Anyway, so we'll take that defensive posture as a wait for your opponent to make a move and counter. And so therefore, what do you advise people to do to sit and wait? Because we get feedback and they're like, hey, how come you didn't see this move coming? Or how come you didn't jump on this? How do you respond to such feedback from that?
Sure. No, yeah. I mean, what I would say is that we are going to have resolutions within the narrative. So as we get a resolution of this particular situation, most of your interesting opportunity is going to come after that fact. When the market then is starting to do price discovery around it, you start to get people leaning too far one way or the other, the pattern starts to take hold, and you get a market that's more about the trading action that happens after all the information is known by all participants, rather than is about trying to predict what the next information is. In other words, you're back to predicting the movements and decisions on an average of a crowd of people, rather than trying to predict what a single person is going to do. So you're back to being the person deciding what consumer sales are going to be tomorrow rather than whether Bob Johnson's going to go to Best Buy and buy a TV. So you want to get back into that situation. So it really is better to be really sparse, really cautious and selective until you get past the big headlines. And if we go back to, and this is something Gavin wants to talk about as well, and I'll let him go further with this, but if we go back to November of last year, we had a situation where we had a big meeting. I think it was the G20 in South America.
Argentina. Yeah.
Yeah. And we had a resolution inside of that. And that turned out to be a tremendous trading opportunity, but only after we got that resolution. And it was on the short side, and it was basically about understanding that what was promoted as an important deal wasn't an important deal at all. But it was after we got the headlines and the sort of final sense of here's what this whole headline experience really ended up amounting to. After that, after the cookie crumbled, and we're just looking at the same set of crumbs on the floor, and people are trying to figure out what they mean, and you start to see patterns of behavior take hold in the market. You start to see people got squeezed out, want to get back in. You start to see some big offers come in. You start to realize as you take a look at things that it's really not that significant at all what was announced, and you get the big shorting opportunity. And that comes after the fact. So really trading now in front of the final headlines that really define this kind of next round of negotiations is, you don't have to do it. And it's probably going to be lower probability. And it's one of the reasons why I've been as selective as I've been.
All right, Gavin, did you want to interject on what Brett was just talking about? Because we did have a similarity not that long ago, and I believe was it a year ago? Was it a year ago?
Yeah, I mean, it's really funny how we're marrying 2018 going into this. Of course, 2018, there was growing concerns about the impact of tariffs and how that was going to play out in Q3 earnings. We had, as per usual, the fall meeting of the World Bank and IMF, which updated their outlooks, and across the board, they had a cut, if you recall, on their outlooks of growth for all the countries. We were trading at near-term highs. We had bounced back from the sell-off that had started in February, and we're getting back up towards those highs going into that October. So, it's just really marrying a lot of the aspects around. And again, we had those talks coming in November last year at the G20 meeting. This time we're looking at an APEC meeting. I think that there's also a potential meeting in Argentina or in Chile, I should say, that could happen around in November too between the leaders. So the idea that there could be enough groundwork done here and the two of them come in, both needing some political capital, I feel. Trump obviously ahead of the 2020 elections, Xi with the Hong Kong issues and just a weak economy in general, both hungry for political wins that could really help set up more of an upbeat tone going into those November meetings potentially. But, just a lot of similarities between this year and last year, and has me wondering if that's kind of what the markets are expecting, a little bit of a dip going into October, and then we start seeing that hope trade going into the November meetings right around Thanksgiving. And if they fail to come to fruition, do we get another aggressive rollover like we saw last December? So it's interesting to see the similarities going around here throughout the course of the year, throughout the two time frames. But I think Brett really couched the difficulties around trading these headlines perfectly. For instance, 2 years ago, the short that Brett put on the NASDAQ this morning, I think would have been a big winner. However, this time around, of course, you have the wild card of one person being able to tweet that would move the markets into the idea that perhaps there is some sort of short-term deal coming in, whether it's the Huawei restrictions are pulled back, be it, I saw an earlier headline about China buying more pork products and stuff like that. And this is enough in the short term to really get us going. But if you were to look at the charts on like a 120-minute or a 60-minute time frame, you don't really see all that much action going on. I've talked about it before in the Jim, and it just feels like two robots playing pong in between levels, and that just makes it really difficult to trade. Obviously, you could go with the argument, well, you just buy at 28.80 and you sell up here at this 29.50 level, and if you'd been doing that over the last 3 weeks, you'd be doing pretty good for yourself. But it's not that easy with these headlines going around. So the idea of just kind of sitting waiting for these headlines to pass and then being able to attack a little bit more aggressively next week as earnings come out and we start seeing a little bit more around the tariff impact. You saw something like a PHG Phillips Group getting really hammered around tariff commentary and stuff. So you might be able to see some opportunities opening up a little bit more on an individual stock basis rather than trying to trade these indices, which just really feel like they're being gamed by bots and headlines the entire time and making it really difficult for a top-down trading perspective here at the moment.
All right, let's move away from the headlines and talk about your overall take on the economy in general. So I guess we can start from a global perspective and bring it back into what we're seeing in the U.S. And I'll invite Brett back in as to what your overall take is. I know you go over this quite a bit in the Sentiment and Flow show, but in case we have anybody new listening that hasn't caught the latest episode, why don't you just give us a quick little bullet point of what you're seeing, what you expect heading into the end of the year?
Well, I think that a lot of things right now are actually, in a way, dependent upon the same things that we just talked about, because sentiment among people who are some of the most important people to keeping the wheels greased in the economy, they're also getting swung around by these very same headlines. They need to decide how many people they're going to hire, how much they're going to invest, whether they need to restructure supply chains. I think the whole idea that you're going to be able to restructure some of these supply chains, no matter how long this lasts, is ridiculous. That's an enormous fixed cost investment. But we're starting to see some signs in for instance, the two ISM numbers that we had over the last couple of weeks, I think really changed the game as far as the assumptions about how the U.S. economy is weathering this. If this keeps moving forward the way that it has, if we don't get any kind of interim deal and we get a further flare-up and further tensions introduced into this equation, then I think you're just going to start to see some of the mentality that led to those ISM numbers start to leak into the hard data. And at this point, we've seen a massive divergence between the soft data and the hard data, with the soft data turning very soft and the hard data kind of holding up. Things like retail sales and the jobs numbers, and that's staying put. But we're starting to see commentary in some of the soft data, some of the economic sentiment data, that people are starting to react to a sense that this is indefinitely going to be prolonged. And at that point, they need to start to shift where their investments are, shift where their decision making is. And that really is why something like the ISM data, and this is what Gavin and I talked about each of the last 2 weeks, really, that's why that's called a leading indicator, because it really reflects what decisions people are going to make over the near term that will eventually show up in retroactive hard data economic statistics. So I think whether or not this looks like there's a step forward in these negotiations will actually have a direct impact on the type of economic data that we're going to see for the rest of the year, and particularly when you talk about whether or not tariffs are going to be placed on some of the items that are so important to sales right into the very end of the year and into the first quarter next year. So yeah, I mean, I think that the economy is kind of reacting to the same thing that traders are, but I think Gavin can probably elaborate on it more on a global basis than I can.
Yeah, I mean, for me, Brett and I talk a lot about the economic data, and I think he's hit it spot on here. It's all about, the big argument in the States is whether or not the consumer strength could outlast the indecisiveness around business spending, and that's really the crux of the question that we're looking at going into this earnings season. And with that, I think Q3 earnings is going to be really key in trying to develop that. We've obviously gotten some of the larger reports, as Brett was just talking about, but next week, pretty big week for the banks. We got all the major money centers. Just Tuesday morning alone, we got Citigroup, Goldman Sachs, JP Morgan, and Wells Fargo. And what we want to look at is the consumer strength there, as well as some of the commercial, and basically looking at bank loans, looking at the credit cards, and that's going to be a key read for people trying to gauge the health of the economy. Are people pulling back spending here on the consumer side, in which case we'll see a little bit lesser credit growth, or are they anticipating higher costs with tariffs and therefore getting a little bit of pull through, which could lead to a little bit of a misdirection from that. So it's something that we're going to have to be careful cutting through. And then looking around, there's a couple of transports out next week. There's JBHT is out, CSX is out, UNP, some big railers. We've seen the Dow Jones Industrial Average fall below the dreaded death cross, below the 50 and 200. And Scott will probably be able to talk a little bit about that. I know he hates the death cross itself, but just talking about patterns that are developing, and what we want to see early on is how these names are reacting. Like FedEx, for instance, it's been one of the first Q3 earnings reports that we've gotten, and that's just been cratered since they reported earnings. It's now down to 140. Do we see similar activity from some of these other transports in here that will probably foretell some of the economic data that we're going to be getting, and really drag down the perception around how the U.S. economy is performing? So some of these earnings next week are going to be really key in giving a gauge on the market sentiment around the U.S. economy. So I'll be looking at the financials and the transports as a key read for us. And even on top of that, there's a couple of tech names, Netflix and IBM, that are going to be going out. So I think that all leads in. But I guess the one thing I would comment about going into Q3 earnings season is we got pretty low expectations going in. We've had people reining in their estimates, and so far there's been 21 companies in the S&P as of October 4th that have reported their Q3 earnings, and 86% of them have beaten. Usually that number runs around 73%. So, that's something that we're going to have to keep an eye out on, just the overall performance, and with the understanding that expectations have definitely been reined in. So be curious to see if we get yet another better than feared report that helps keep us afloat. But it's going to be some big items going on that we're going to be following over the next 2 weeks.
All right. I do want to go back to Brett really quick, because I know you had another point about the economy and economic policies, right?
Yeah, well, I just want to say that everything that we're talking about here, I think one of the most important things to appreciate in this environment, and it's something that is extremely new. This is a new thing. You've heard, don't fight the Fed, don't fight the Fed, don't fight the Fed. If you've been trading for a long time, it's one of the most important rules. And right now is a historical moment where that may start to be out the window to some extent. I think one of the most important dynamics that we're seeing right now is a gradual loss of faith in monetary policy as something that can act as a tool alone. If we start to see deteriorating economic activity, you're going to see the world divide up pretty quickly into political economies that are capable of doing serious fiscal stimulus and those who aren't. And it's going to really divide the playing field, because we are starting to get a zeitgeist forming around major institutional investors that see monetary policy as somewhat impotent in this environment, because it's already been washed down into, $15 trillion worth of negative interest rates, and central bankers consistently lamenting that if they don't get fiscal policy help, their monetary policy tools won't be able to work in a vacuum. So that's a new environment. That's a new dynamic. And it really, you can't appreciate the economic environment without also appreciating that same factor. Bad has been good at times because it meant we'd get the next round of QE or the next round of whatever. And I think we're finally at a place where bad is bad. So keep that in mind. We saw a preview of that when we got the ISM numbers and we saw the market get the floor ripped out from under it. Bad is bad. So if we start to see bad data, until they can show a bazooka in their pocket on the fiscal side, bad is bad.
So what does that mean, Brett? It sounds somewhat doom and gloom.
not doom and gloom. It's just if we get a bad economic data point, it's probably going to react to the downside because it's not going to react as here comes the next round of QE. And if it does, initially, you want to fade that. But if we get a good economic data point when people aren't positioned for it, you're going to get a boom to the upside. And there's nothing to say that we won't start to see. We may be seeing right now, we get a little bit of a China deal. Maybe we get some traction on things. Maybe we can show we've got a fiscal resource. People are malpositioned to the upside. That could be, boom rather than doom. It's either way. It's just we're used to an environment over the last decade where we have a bad is good mentality, or a data doesn't matter kind of mentality, where you see, that every kind of seeming downturn is met with the notion that the Fed is going to step in and save the day. And it just seems like we've turned a corner over the last 6 months to a year where faith in that idea, particularly watching what's going on in Europe, watching the transition out of a Draghi-led bank and also Draghi endorsing this idea that, they've done just about as much as they can do. And look where it's at. I mean, Germany is already possibly slipping into recession with negative interest rates and a massive rate of purchases going on by the central bank. So, there's just a reality setting in that central banks can't just do everything. They can't lift all the weight. And if you've got an economic system, and I think the EU is a good example, where it's awfully difficult to get serious fiscal stimulus help, then you're going to see a situation where bad economic data leads to declining asset prices. And that's a relatively new dynamic if you think in terms of the last decade or two, that's a new dynamic.
Indeed, it is, Brett. But then what? Then what happens? I mean,
we'll find new tools. I'm sure that we'll find new tools, but we haven't yet.
Well,
Okay,
it'll have
so
to be fiscal. But as Brett said,
right.
not everybody can.
We haven't gotten organized on that front. Yeah.
all right. So as far as what we have coming up, we got to talk about earnings season, and that'll probably be an easy way to bring Scott back into this discussion, blue chip trader. I know you really do have a lot more trades going on during earnings season. And one of the things that I want you to be able to articulate to people is the disruptive gap theory that you have, because you go to it a lot, you talk to it about it quite a bit. And so I think that if we can prepare the listeners for what that is, they'll be in better shape to identify it and maybe catch ones that you don't even that don't cross your radar.
Yeah, sure. I know I'm being recorded here, and this might be the first and last time you ever hear me say this, because as a technical-based trader, I'm actually looking really forward to this coming fundamental earnings season. And that's just because I'm so tired of the tariff rhetoric and the whipsaw activity that's been going on here on a day-by-day basis the last couple of weeks. It's getting nauseating at how fast algorithms are just kind of quickly reacting to every single headline, and what looks good technically on the charts at 1 minute is just you're getting the rug pulled out right from underneath you on a long and a short basis. And quite frankly, it's annoying, and I think it is drying up a lot of liquidity, and it is having people just not participate and really kind of holding back and keeping their share size low and putting out more hedges and whatnot. So this coming earnings season, it's already started getting underway a little bit with Delta and the like. But next week, obviously, we're going to have a bunch of the financials and the banks coming out. And I think top and bottom line growth of sorts is really going to be the main driving factor for a lot of opportunities over the course of the next few weeks. So, yes, I am looking forward to that. As for how to approach it, so I have, there's always a few strategies to always go into some earnings. Now, there's two main ones that I do like to follow. The first one would be a pre-earnings type of play. And this one's a little trickier because you have to go out and look on the calendar probably what's coming out a full week in advance. So if anyone's not familiar with the feature of the calendar, it's just a main drop down at the top of the screen there under calendars. You click on the first subtitle, it says earnings results, and that should bring up all the upcoming earnings reports for that day. There's a little subtitle down below that says this week, and as well as going out to the following weeks that you can look out ahead on. And that's typically what you want to do if you want to take these pre-earnings type of setups. In my experience, stocks definitely uh, they f- they tend to get bid higher. Of course, the current environment takes precedence over what happens, but generally speaking, you will see stocks get propped up a little bit in the days leading into their earnings report. For next week on Tuesday, October 15th, we have J.P. Morgan. So this is a great example. So I did not take this trade, but I did highlight it on the TA page scans this morning, if you were paying attention. What happened with JP Morgan and what brought it to my attention was the fact that it showed up on the doji candidates. And the doji is a candlestick pattern where the opening and the close are very closely aligned with one another. And if you look at yesterday's price action for the 9th, you'll notice that that is exactly what happened. It looks almost like a cross on a chart on a daily time frame. I incorporate a little bit more filters on the TA page scans. I request that for doji patterns that they are also one of the more narrow ranges that have developed over the last 10 days or so. So this one really kind of jumped out to me on the page when I was looking through all the scan results as a name that would have to be on traders' radars, particularly because of the way that it's fallen over the last 2 weeks. It's hanging around the 50-day moving average, and earnings are coming out in about 4 days from now, 3 days from now. So this is your classic pre-earnings pop. Like I said, I didn't take advantage of it this morning. There was too many other things going on with the futures and the way the market behaved right out of the gate. But if you were quick enough and you were savvy enough, you could have easily capitalized on this type of movement. And that's basically one example of these type of pre-earnings movements. They don't all always go higher, but when you get a combination of a nice clean technical setup like a doji pattern after a corrective move and futures are strong, you can somewhat take that risk to get involved maybe 2 or 3 days ahead of their earnings report. Another example, and this is the other one, this is more of a post-earnings play. We'll use Delta as an example since they just had earnings. DAL. So you look at a daily time frame. Usually it's good to look at the last quarter or so of time on a chart because that's basically where the most risk lies, or the people who have the most at stake on going into the upcoming earnings report. So looking at the chart of Delta, you can see that basically peaked out back in early July, mid-July, around $62, $63. And it's just been on the slide, just not really doing a whole lot here throughout August and September, actually going underneath the 50-day moving average and struggling a couple times to actually surpass it. And then more recently here in October, you did have a significant breakdown to a fresh 3-month low and sort of this kind of flushing out move that took it down towards the May and June lows in that $52 area before it actually did a little bit of a bounce ahead of earnings here. Which is another story. If you were to go back a week ago and look at the earnings report, again, you have a stock that was hit about 5-6 days pretty aggressively. You could have had this one on your bounce radar leading up into the earnings report for maybe a point or two. But nonetheless, going into today's earnings, the way I would look at this is that the last quarter, there's not a whole lot of happy longs. And in fact, there probably are not very few longs. A lot of people probably turned sour on this stock based upon the recent price action over the course of the last few weeks and its underperformance. And they probably got out over a week ago. And there's probably very few people that were committed over the course of the last few days of support off the $52 area. So when today's earnings came out and stock price gapped down, it wasn't exactly what I would call disruptive. In fact, it only gapped down about 4%. And it was pretty much on the mend very quickly there in the face of broader market futures and the market being very strong this morning. So this is going to be your classic gap down type of reversal session looking for a trade there. And it's also one to keep on the radar. If the market does continue to lift, this could easily be a name that's going to bounce back and maybe get back to yesterday's close around the $54 area, or maybe the 200-day moving average around 55, or the gap around 56. it is a little stretched or far away from the 50-day moving average. So there's a lot of different things here that suggest that there is probably a very low risk bounce play here underneath the current session's low. And potential, a lot of more potential to the upside in this name, because it wasn't that disruptive. It didn't really catch a lot of investors off guard based with that 4% gap down and based upon the activity that's been underway here. And that's really what I'm going to, that's like my main bread and butter staple for earnings season. Now, of course, I can't trade every single stock. Some days it's crazy with the hundreds of names that come out. But every now and then I'll find a name with enough liquidity and enough price action that I'll capitalize on for some sort of quick day trade. Hopefully you turn these day trades into a little bit longer of an overnight trade and capture a swing of sorts off of them. But that's generally what I'm going to be looking at. And that's my definition of a disruptive gap. In this case, there was nothing truly disruptive here. I don't have an example right now off the top of my head of one that I could give, but you know what would be, I guess, that F-Scout. There was that FSCT stock today. Now, they didn't have earnings, but they did warn. Okay, so this is a perfect example. So you look back the last quarter or last few months, and here's a stock that's basically been range bound between $30 and $40, and even somewhat grinding higher the last couple weeks, showing relative strength in light of what the market's been doing. Okay, it's back above the 50-day moving average. So there's definitely some accumulation that's been going on, or some longs that have been pretty happy with their overall way that this stock has been behaving in light of everything else. Well, unfortunately, they got blindsided by this warning, and the stock actually opens down about 35%. This is not a name that I would keep on my bounce radar for today in these scenarios. You're basically gapping down to fresh multi-month lows. You have a number of longs that are just super unhappy. They're down 30% plus in their portfolio. They're probably not going to add. They're probably going to look to dump this stock. They're going to sell first and ask questions later. And those are going to be the disruptive sort of gaps that you are going to want to fade any sort of initial bounce or opening reversal to the upside that fails. And I think if you got short this one somewhere, on an intraday basis around $27, $28, you had a nice little trade there, and you're looking like there might be some more weakness coming this afternoon below 25.
Yeah, actually, that is a great example, Scott, that FSCT of, if anything else, to stay away from this, because it's very enticing to try to get into a stock that's moved this much, and you just think, as a trader, you got to buy the dip at some point, right? Because it's just somewhat natural for us to think that way. However, you got to know which ones to stay away from. This is a great example, and you can see how it tried to make a move back through 28. It got rejected. Here you are, $3 lower. So yes, chalk this one up as a good example if you need a bullet point for a disruptive gap and what they look like. Very textbook, I would say.
I'll give one.
Hey Scott,
Yeah,
how about
what's up?
AdTran?
What's it?
ADTN? Another one
ADTN?
that guided this morning. Would be curious because they already had a disruptive gap back in July around pretty poor Q2 results.
Yep.
And obviously they came out with dismal guidance breaking below the 15. So yet another disruptive gap here. But what would the difference be between the cybersecurity play you just mentioned and AdTran, which kind of has the feeling of a few disruptive gaps here, especially if you look at it on the weekly. Feels like they get one of these every 6 months.
Okay, so again, I try to focus. There's a couple ways you look at it. You look at the bigger picture. It's obviously been trending below the 200-day moving averages for over a year now. It's been underperforming broader market overall. So the sentiment around the stock is just poor. It's just the expectations, the bar is set pretty low. So for them to be continuously gapping down in response to earnings is probably somewhat of an expectation, all right? Now, again, shorter term, I like to look at who's getting essentially trapped over the last quarter because they propose the most risk in my mind. And if you just look at the price action the last 2 months or so, the stock's been trading between 10 and 11.50-ish, 11.75. So you definitely have some sort of stabilization. The recent pop back above the 50-day moving average gives it more of a little bit of a bullish slant here the last couple of weeks. And then you get, again, blindsided by earnings report. Stock gaps down over 20%. Anything beyond 10% is usually a standard cut your losses type of behavior. Talk to any portfolio manager or anybody that really is about controlling their risk, which you would think would be most people, but if they want to get out of positions. If anything gaps within 10%, it's usually something that they just have to relax and wait on, and then they say, okay, let's see how it plays out. Maybe I'll add some more, if the story's still there or if the stock holds up. We'll see how it plays out. But once you go beyond 10%, that's basically the word. That's where I define disruptive. You're disrupting a lot that's going on there, and in a name like this, where it just gap down 20%, it's head for the exits time, and I would again view it as a short. Now this is all kind of like a shorter term type of thing. Now anything can happen days from now. I mean, maybe the stock stabilizes and comes ripping back because some new fund finds value in it of sorts after there's a climatic sell-off of sorts going on. But that's basically the general assumption you want to make. One final example here, and then I'll just let Damon talk about some of his recent trades and investments. But Helen of Troy, I think it was HELE, had earnings a few days ago. So this one is a retailer, and you can see over the last 6 months or so, pretty strong price structure, just rising above the 50-day moving average gradually. And then it had earnings come out about 2 or 3 days ago. So going into earnings, you look at this price structure, I would say that, again, everyone's pretty happy with what they've received, over the last few weeks in light of what the market's been doing. And then earnings come out and the stock gaps up about 6%. The 6% gap is great, but are people really going to be chasing or adding to their current existing holdings, based upon the current market conditions and the nice little stability move that they've had? And probably not. It's just not. They probably saw this as an opportunity to lock in some profits. And again, this happens to the upside too. When you get a gap that's less than 10% to the upside and a stock that's doing well, you're typically going to see more profit taking take hold as opposed to people adding to their positions for further upside potential. Now, once you get beyond a gap up of 10% in a strong stock, that's pretty much a whole different ballgame, because that usually that plus 10% gap in a strong stock, it basically hits the reset button on the chart. You're not going to. You would think naturally that you're going to get like a lot of profit taking on a large gap up percentage wise, but in reality what happens is you have like all eyes on this chart and you have new money just going after that new fundamental story that's there and kind of supporting it and trying to get involved and push that stock higher and starts establishing a whole new support level. So it's kind of it's definitely a tricky game of sorts, but I think the key thing you have to do going into earnings season is to focus more so on the last quarter's time frame, and you can kind of get a gauge of how they're going to respond based upon the size of the gap. Typically, it's not a fine line, but typically somewhere plus or minus 10%.
All right, Scott, do appreciate the education piece there on these disruptive gaps and some of these different ways that earnings related moves can happen and some ideas out of that. Now I'm going to bring in scalp trader Damon, and you have a different way of approaching some of the markets to avoid some of the volatility, in which you guys can take advantage of some things in your spec portfolio, your yield portfolio, and a couple of the names that I think we should bring to everyone's attention is MNK, because you not only participate in the equity there, but also the bond, the MNK bonds. You also got NGL preferred. So why don't we start with MNK, what you like about this distress asset?
Hi, Jim. I just want to change the subject quickly. I just posted a comment, new spec long on Bloom Energy. Now, you guys are probably somewhat familiar with this one, but I'm posting it as a play on the California planned blackouts by PG&E.
Mm-hmm.
Um, we've seen some other stocks run up in on this as a play. But I think that this company is kind of making the case, and I posted a link to their website on why they're a better solution than generators, and also like the fact the stock's sitting here at 52-week lows, has a big short interest, somewhat controversial name. So just put that out literally seconds before I came on the air and wanted to point that out. So doing a lot of work right now in the speculative area, and Mallinckrodt is one of those names. I think we put on a position probably about a month ago in the 175 or so area. It actually ran up to $4, above $4 over the next couple of days, scaled out of most of the position, and have a trailing piece with the stop at the entry. But I've also jumped into their bonds as well. And the bonds are right now trading about 28, 29 cents on the dollar. And my view, after doing some research and really reviewing kind of the approach that some of the plaintiffs' attorneys are taking to these opioid lawsuits, is that they basically want to bleed these companies, not kill them. I mean, I think they understand that bankruptcy really throws a monkey wrench in the whole process and can add years to a resolution. And so after reading some of the commentary out there by some of the plaintiffs' attorneys, it looks like they really want to come to some type of global settlement. And because there's so many companies involved, and there are some big companies like drug distribution companies, as well as the actual drug makers. There's some big names out there with deep pockets. And so I'm betting on a global settlement that basically allows companies like Mallinckrodt, which is much smaller than some of the other names out there, to pay what they can and to kind of provide an ongoing payment into this pool of money. And so I think if that happens, if they get a global settlement, I think the stock triples, and I think the bonds double or triple. I think the bonds would probably triple as well. Right now, they're trading about 28, 29 cents on the dollar. They do have the CMS situation that they're expecting a ruling on by the end of the year. If that comes out favorably, I think the bonds double and the stock goes up 50 to 100%.
Wow, those are some pretty nice gains there. Now, you are doing this in your spec portfolio, correct?
Yeah, both the Mallinckrodt, the bonds, as well as I haven't put on an official position in the bonds. I mean, so the bonds I'm talking about here on audio, bonds have become very difficult to trade. Just the liquidity. I think down here, I mean, you have decent price discovery, but when you get a distressed bond that's trading in the 70s or 60s, when you want to go sell it, everybody wants to sell it, and the next trade may take place at 25, right? So I prefer to participate in bonds that are either trading, they're attractive on their own right on a relative value basis, or on the distress side where they've already been dumped. And so the price action at this point is really based on whether it's going to go bankrupt or whether it's going to be some type of major recovery in price. And to have people who are a little bit concerned about not wanting to hold paper that has the potential to go bankrupt, they've already kind of blown this stuff out, blasted it down to the low 20s, and they've gotten out. And so that's where Mallinckrodt is now. Got blasted down to about 24, 23, 24, bounced back to about 32, 33, sitting right now around 28, 29 cents on the dollar. And I think it has decent upside. But again, these are relatively illiquid situations. So, unless you have a background in trading bonds and kind of really understand the risk there, I would be careful about those. But I just wanted to point out that is a position that I own, collecting. These bonds are 4 3/4 is the coupon, but the yield is obviously dramatically higher than that, just given where they're trading and where you can buy them.
All right, and then another Another way you approach some of the yield portfolio is with the preferred stocks as well. In this case, NGL. And I don't know the ticker for the NGL preferreds. Do you have it handy?
Yeah, so the preferred C, which is the one we have in the portfolio right now, our yield income preferred portfolio, that we bought these originally around 24.80. Right now, trading at 25.22. I mean, this is a 9.5% coupon, which is obviously very compelling in this type of environment. I, I really like this name, and I'm really surprised that it hasn't traded up to like the 27.50 area. Yeah, so interesting name. I own it. I have it in the portfolio on the site. Hard to find 9.5% these days, and their coverage, their distribution coverage for the preferred is quite high. Company has been doing a lot of things to build out their asset base. They've reduced leverage dramatically over the past few years. And the actual underlying stock has performed very well.
Yeah, I'm looking at the NGL, just the basic stock. NGL is the ticker there, and I do have it on the chart. So it has pushed off those lows a bit. Are you involved in the common stock here at all?
Yeah, so we bought the common stock, and this could have been a year ago or less. Actually, it might have been looking at the chart. It might have been January actually. Bought it, I think, at around $8.75 or $9, and sold it. Most of it, I think, in the 14.50 or so area. We still have a trailing piece here with the stop at the entry, I believe. So yeah, that's done very well. But I sold it because I thought the common had gotten a bit overvalued, so I wanted to take profits on that. But I still think the preferred is extremely attractive, and I'm planning on sitting on that as a long-term position. And the other yield name that I still really like is the MRRL, which is the 2 times long mortgage REIT ETN, which we also own in the portfolio. It's currently yielding just under 20%. We had a big trade in that earlier this year. Sold it based on the spike in mortgage refinancing and the issue with the repo rates that were stubbornly high. The Fed has come in and provided some really strong support to the repo market, and those rates have fallen dramatically, which boosts the yield significantly for these mortgage REITs. So I think the outlook for the mortgage REITs is very good from here, especially if we can get rates to just stabilize right in this area and take away some of the refi risk of some of the mortgages they have in their portfolio right now.
All right. Are there any other key themes that we really need to focus on heading into earnings? This one goes out to anybody. Maybe Gavin, do you have something that you're keying in on?
Yeah, I'm looking for entries into the semiconductors on selling. I think Micron would be a perfect example of what I'd be looking at, where they came out with their earnings and it broke below the 200-day, or not the 200-day, but it broke down below that 50 level and just continued to sell off down to 42. There's some negative trade headlines too at the same time weighing in on the stock, but what I'm looking at is bad numbers coming out for Q3 and a little bit of a lighter outlook for Q4, which I'm viewing as conservative, and thus expecting to see flushes and potential buying opportunities. Seagate STX is one that I'm eyeing up. I might look to get in a little bit earlier. And one early read that we'll get on this market will be ASML, the Dutch semiconductor play that's reporting next week. So that's one theme that I'm looking at going into this earnings.
All right. Is there anyone else who has any other advice as we navigate through this treacherous time with headlines and earnings and what have you? Any advice out there from you pros?
I'll jump back in here, and that's I'm still in the mindset of playing smaller positions just because of that whippiness and the activity that's going on there. So, this will pass, and hopefully we get to flush out in one direction or the other and open up a little bit more trading opportunities. But for right now, you're just looking at an uncertain market. That nobody's really looking to buy above a certain level, and people are willing to stick around if things drop to a certain level. And until we see that chain broken, it's just going to be a pretty whippy action. And this could go all the way into 2020 potentially as we get close to election season. But, it's just a matter of being patient right now.
Yeah,
I'll just add. Go ahead, Scott.
Thanks, Brett. Just keep it simple. That's always been my approach. There's so much going on out there. You can really just drive yourself batty with the amount of contradictory kind of information that's out there. But I would just say keep it simple. If you're a trader and you're looking at all these headlines, you don't know which way to go. All the information you need is pretty much going to be right there, looking at the charts as well as the sentiment data. And I think listening to Brett and Gavin's weekly show, the Sentiment and Flow show, I think it's on Tuesdays, right? That's
Tuesdays
always
at 2:30.
Yeah, always a great indication of how the market's positioning, cash positions, option positions, etc., to try to get a feel for sentiment. And then the charts. I mean, the charts aren't going to lie. That's exactly where the money is and going. And if you are struggling because volatility is above 15, which typically means that it's more of a day trading, scalping type of environment, some below 15 for the VIX is more of a stable type of environment that warrants more swing trading or holding longer term for trends and whatnot. You just have to pay attention to what the current market conditions are and dynamics are. Or, the easiest way to do any of this stuff is really just to go out on your charts to larger size time frames. If the noise is getting to you, we'll reduce the noise. And the way you do that is by stop looking at the, 5-minute, 15-minute time frames and start going out to more weekly time frames, even monthly time frames, to get a sense of the bigger picture of how the real money and the big institutions are positioning themselves based upon all the day-to-day whipsaws. That will always steer you in the right direction of the market by looking at larger time frames.
Yeah, and I would echo a lot of those thoughts, and I'd just say just exactly as Scott just put it. At the end of the day, the most trusted point of input that you have is really the way the market is behaving. And if we get past this minefield that's particularly situated around this specific round of negotiations between China and the U.S., we get the headlines out, we see what we have, and my inclination is to assume, because Trump is still at the table after understanding that structural issues are off the table, that there's probably going to be some kind of announcement basically exchanging larger ag purchases and a currency agreement for forestalling new tariffs in October and December. And we're going to see that spun up like crazy as some really important event. But after that's all out, what you're seeing in the market is going to look like one of two different things. It's either going to look like you're seeing a lot of sideline money that's been overhedged, look to get in front of a positive end-of-year run, and we've got a big long-term setup that could move in that direction. We had the S&P sitting in what could be like a weekly time frame level bullish ascending triangle coiled up under the 3,000 level, and we just hit an average put call of 1.14 on this pullback, which is a significant bottoming signal. That's all still in play. But you could also see, in response to all those headlines, in response to all them being played up really big, you see that lead blanket offer sitting on the market, and you watch a morning of lots of good news on a big gap up just get reined in on by huge selling that's really going off on the offer, and that offer is gradually starting to chase the market down, and the volume is high. It's the same thing that we saw essentially, just as Gavin brought up, last November, that really signaled the beginning of a larger decline that was setting up, where there's some rough events ahead, and the headlines are being used as a means of getting some large money out of the market. So at the end of the day, the default the most important point, the biggest input is going to be the nature of the way the market is behaving after we get a lot of these headlines out of the way. And the bigger opportunities will be at that point, not in front trying to guess what the next headline is going to be. So if I had any big picture framing message for how to make money from here to the end of the year, it's to think in those terms.
All right, and then I'll give my pro tip of the day. One of my first mentors told me, if you don't know what to do nothing. And I think that this is one of those cases where sitting on your hands, if you don't know what you're doing, might be the best approach. And the reason why I say that is because the best thing you can do for yourself is not get chopped up in this uncertainty and have dry powder and a fresh mindset for when the opportunity does come. Now, let's talk about what Gavin might have said, or what he did say earlier about how this is beginning to rhyme. The market structures beginning to rhyme a lot like it did last October. And what did we have? We had a fallout, and then after things kind of settled in, Brett Manning would attest that one of the best trading periods of his life came in the last part of December. And without being frustrated, he was able to capitalize on that. And that's what I think you want to continue to have in your mindset, that if you don't know what you want to do and you don't feel you have an edge and you're not on top of your game, then wait until you are, because there will be opportunities and you just never know when that may be. I didn't even think that the end of December would be such a great trading, but Brett, you would
let me just say, yeah, I was having a very good year up until then, and the last 2 weeks of December doubled my year. And I did not do much trading during the difficult period in early November. I traded in October. It was very helpful, but the last couple of weeks, and particularly the last week of the year, was a massive increase in where I was at in the year. And that's because the opportunity was there. It was literally fish in a barrel for the style that I had. And that's when I started taking larger risks and more frequent trading.
So there you have it. I know it's frustrating. I know it's hard to look at the market on a daily basis and say it moved 1% this day and sold off 30 points the next day, whatever. How did you not see this coming? Because it's difficult. And if we don't have an edge, then we're not going to risk your money or our money and put anyone in a position where the probability is set up for failure. So just keep that in mind. Sure.
Let me interject one final point. I said I wrote an essay a couple of years ago, actually several years ago, but likening trading and a good trading philosophy to the way that Floyd Mayweather boxes. If you're a fan of boxing, if you've ever watched some of the career highlights for Floyd Mayweather, he wasn't always really just a counterpuncher. He was selective. He would measure his opponent. He would figure it out. But when the moment was right, he would become an offensive hurricane. He would attack like crazy. When he knew that he had his opponent where his opponent was most vulnerable, he would go for the kill, and he would kill at that point. I mean, he had a period during his first 30, 35 fights where everything was a knockout, but he didn't get aggressive right off the bat. He let somebody get sucked into a rhythm. He counterpunched where he needed to until he finally had that vulnerability moment, and then he just went in and he cleaned up and he killed him. And that's the way you trade. You're very selective. You use risk as an asset, but when the moment is right, you go after it big time. You go for the throat. And you don't go for the throat all the time. You go for the throat when everything is stacked in your direction. You try to push over the tree when you find a dead tree that's leaning over and the wind is blowing in that direction, and you push on it. You push the thing down. But you don't go up to a fresh green oak and try to push it over. So it's just about finding where the opportunities are and then going for the kill, rather than going for the kill every day.
All right, well, how's that for a late round flurry TKO knockout for this one, Brett and everyone else? Thank you so much for doing the strategy session with us. As always, it's been educational. And yes, we will have this recorded and you can listen to it again. It's a great one to take notes on. Great strategy tip as far as earnings go from Blue Chip. So, gentlemen, thank you, as always, so much.
No problem.
Have a
We'll
good one.
talk to you soon.